$30,000 of it subject to ordinary income tax rates, 10% to 37%. The remaining $10,000 is going to be subject to capital gains rate. Those are the most favorable, right? 0%, all the way up to 20%. But we do have to do depreciation recapture because we've taken that benefit of depreciation expense. And remember, even if we didn't take that expense, that asset qualifies for depreciation. We have to go ahead and take depreciation recapture. This is why we don't want to miss depreciation expense for fear of having to pay ordinary income tax rates later. Because if we don't take depreciation, IRS is going to take it for us. Not to their benefit to reduce the income, but to this benefit, that when we sell an asset, we're going to have depreciation recapture. Let's talk about a loss on a sale of equipment. Because what do we know about equipment and machinery? It goes down in value. It's really hard to get a gain on the sale of an asset. Let's say here we actually have a sales price of $7,000, but we still have adjusted basis of $10,000 on the books that we haven't written off. We haven't taken a depreciation expense on that. So we have a loss of $3,000. That is allowed to reduce the rest of our income. We don't have to worry about depreciation recapture, only when we have a gain on the sale of an asset. Let's talk about assets that go up in value. Real estate. For this example, we bought a house, a rental home for $200,000. Step number one, separate the value of the home from the land. Because we know that land is not allowed to be depreciated. It doesn't go obsolete. So let's say we found in the property records, the district records that the land value was $30,000. So what can we depreciate? $170,000 of that asset. Let's say we sell it 10 years later for $280,000. First, how much depreciation did we take, or should have we taken? $61,000, let's assume. We have to take the adjusted basis. We had $170,000 minus the depreciation that we've taken, plus the value of the land of $30,000. Leaves us with adjusted basis of $138,000. But we sold it for $280,000. That leaves us with a gain of $141,000. So now is where we step into the question. How much of that gain is ordinary income? How much is it capital gain? Okay, how much should we have taken on depreciation, or did we take on depreciation? Was $61,000. And this is called unrecaptured Section 1250 depreciation recapture. That is going to be subject only to a maximum of 25% of an income tax rate. The remaining is capital gains. In this example, $80,000 subject to 0% all the way up to 20%. So it really is splitting that gain on what we took for depreciation or we should have taken to depreciation. So when you don't sell an asset, you can still have depreciation recapture. And this happens with listed property only. The most popular example, what did I say about listed property? Vehicles. So what happens year 2 or year 3 when your client uses that vehicle 50% or less for the business? We have to recapture depreciation. And what does that mean? There's several steps here, but here summarizing it for you. Basically, we have to go to year number 1. This is why it's so important to ask our client for their prior year returns and those depreciation schedules. How much depreciation did we take on that listed property on day 1? How much was it on day 2 or on year 2, year 3, year 4? We need to calculate it all over again. Because what happens if we use that vehicle more than 50%? What did we use? GDS. Now that it's listed property and it went down 50% or less, we should have used ADS. We have to go back and recreate the wheel on depreciation using ADS, which is straight line and which is more years. So let's look at an example. Let's say our client, he's a sole proprietor. He placed his vehicle in service on January 1st of 2024. Here's his mileage log. Of course, in the real world, we're not going to accept these kind of numbers, right? They're a little too perfect. So let's say you drove it 10,000 miles. Out of those 10,000 miles, 7,000 miles were business miles. That's a 70% business use. So when we look at this asset, we know it's 5 years, GDS, because remember it's listed property and we used it more than 50%. It's going to be 200 declining balance because that applies to assets that are 5 years. And then it's half year, right? If it's the only asset they purchased, even though they purchased it at the beginning of the year, it's going to default to half year convention. Here's what we see on the 4562. Do you see where it talks about listed property? We list it here. We talk about, let's say he bought it for $10,000. Our depreciation for the year is $1,400. Everything looks great on year 1. Client comes back on year 2 with his perfect mileage log. Now it's 5,000 of business miles for that year 2. He still drove it 10,000, but only 5,000 were business miles. That's 50% business use. Now we have to figure this out all over again. This asset is now subject to ADS and straight line. So now for year 2, we see that the current year depreciation expense is less because we learned that ADS is less, right? $1,000 for the year, and we see that the convention is straight line because it's ADS. However, let's talk about the recapture for depreciation. We have to go to year 1. What should this client have taken as a depreciation expense under ADS? We see on step number 6, it would have been $700. But we took $1,400. So what's the excess? The $700. That $700 has to get reported on the 4797, the year that the business use went down to 50% or less, and then has to be claimed on Schedule C as other income. You see, a lot of this gets missed, but this is us understanding the rules, because I will tell you the auditor is going to explain this to you, and it's going to assess penalties and interest if you're not recapturing the depreciation. So if we step into tax planning, right, because we know depreciation is more than a deduction. We need to make decisions. So let's talk about bonus depreciation. That always seems really amazing, 100% write-off. And now with the One Big Beautiful Bill, if you purchased an asset and placed it in service after January 19 of 2025, 100% deduction. The great thing about bonus depreciation is that it can create a loss. It can create a loss. You can use that loss to offset any other income. Bonus depreciation is automatic. By default, we always take bonus. Now, if you don't want to take bonus and you want to take makers, GS, and spread that cost longer over the life of the asset, we have to elect out and submit an election statement with our 1040 or with our tax return stating we are not taking bonus depreciation. When we talk about luxury auto limits, I know it uses the word luxury, has nothing to do with the brand of the car. Luxury auto limits is just the word that's given to all of these vehicles that are placed in service for the business. If we are deciding to take bonus depreciation on year 1, we're limited to $20,300 for the year 2026. But if that vehicle weighs more than 6,000 pounds, which is I think what you've seen on social media, all these influencers advertising to buy that truck by the end of the year, if that vehicle weighs more than 6,000 pounds, absolutely, we can write it 100% for bonus up to $20,300 for the year 2026. Qualified production property. Have you heard of this? Can we take bonus depreciation on real estate? Usually we can. That's always been the rule, except for this that came with the One Big Beautiful Bill. Where finally, surprisingly, real estate, instead of depreciating it over a commercial building over 39 years, we can take a write-off on year 1, 100% bonus depreciation. But the rules are very strict. 1, that taxpayer has to be the original owner of that building. It has to be a brand new building that construction started after July 4th of 2025. Construction had to finish by January 1st of 2029, and it has to have been placed in service, this building. And not only that, but that building has to be used to produce something, a good. Be a manufacturing factory, it has to produce some kind of good that is going to get resold. And if you meet those requirements, 100% write-off on year one for real estate. Then we have Section 179. Section 179, again, you can write off that asset 100%, but it is limited to income. If you don't have enough income, it cannot create a loss, and you have to carry it forward if you're electing Section 179. It also comes with luxury auto limits if we are taking Section 179 on the vehicle. And then we have the de minimis safe harbor election. This applies to those assets where the value of each of those assets is under $2,500. We don't have to put it on the depreciation schedule. Instead, we can just take it as a write-off as office expense, administrative expense if it's a computer. But you do have to make sure to attach a statement. It's an election year after year to the tax return, letting the IRS know you are taking a de minimis safe harbor. You have to have a policy in place, a company policy that states this: every asset that is purchased with a value under $2,500 or less can be written off and does not have to be depreciated. As long as you have that on record. Now the client might know about this. You can come step in as the one helping with this tax planning, being the advisor, to let them know about these rules and help them do this kind of policy, show them templates that they can implement. But you do have to attach an election that year that you are not including those assets on the depreciation schedule. So tax pros, we have to first determine what was purchased, is it depreciable, the recovery period, and the method. Of course, the disposition. What's going to happen if we were to ever sell that asset, or if that asset falls under the 50% or less of business use? So let's talk about an example where we are going to look at this as an advisor. We have a business owner that purchased 10 computers at $1,000 each. So they paid $10,000. Before writing anything off, their profit for the year is only $3,000. So what are we going to advise our clients? We have to look at beyond this asset. Remember, it's depreciation is a decision, not just a deduction. So factors that we have to consider for this type of example. Client, you have a $3,000 gain this year, your profit is $3,000. We still have $10,000 to write off. What other income do you have on your tax return? Do you have W-2 income? Maybe another business income? Do we need to bring that income down? If so, what can we do? Bonus depreciation, right? We create a loss. We write it off for $10,000. We have a loss of $7,000 now to write off, lower down that W-2 income. Could we take maybe maker's depreciation with GDS and spread it over 5 years? Well, client, how is your profit today? What are you expecting for the following 5 years, or maybe even next year? Maybe if it's consistent at about $3,000, it'd be nice to spread that cost for 5 years. What about future income? Maybe this was year one for the business, where they bought all of the assets that they needed to buy, and that's why the profit is so small of $3,000. But next year, we're not going to have those deductions anymore. We bought all of these assets today. At that point, I would advise Section 179. What do we know about Section 179? It's limited to profit. We can't create a loss. But what happens? In this example, we have $3,000 of a gain. What was our computer cost? $10,000. If we elect Section 179, we're only allowed to take $3,000 of a depreciation expense, brings our profit to zero. What happens to the $7,000? It's going to get carried forward to next year, because next year we're going to have profit greater than $3,000. We're not going to have that many expenses like we did in year one. Year 2, we're going to be hunting for expenses. And we're not going to advise our client, go buy a car just to reduce the income next year. Let's figure this depreciation out, take Section 179, and reserve that extra Section 179 carryover for next year. Another option, the de minimis safe harbor. We can also create a loss, just like bonus depreciation, offset other type of income, but we don't run into the risk of depreciation recapture. We don't have to take that time to add all of those assets to the depreciation schedule, but we just need to make sure that we have an accounting policy in place for the client, and we attach an election to the tax return. Maybe we do just regular depreciation, spread that cost over the 5 years. If our gain or this profit on the business is going to be consistent over 5 years. So this is where we're stepping into advisors. We're here learning more about depreciation and not just letting the software make that decision for us. We're seeing it beyond that deduction. Because depreciation is more than a deduction. We know that it's a decision that has to get made, and us as tax professionals, we need to understand the rules of depreciation so that we can guide our clients to make that decision based on clarity, based on understanding, but most importantly, based on the tax results today and also tomorrow. Thank you everyone for having me.